Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
PSU funds have turned from sleeping giants to rising stars. The PSU index alone has doubled in the past 1 year and has handsomely beaten the Nifty 50. Names like Coal India have delivered 20% return in this year alone. With the government focused more on spending another 11 lakh crore this year, I think it's time to ask, is it the right time to invest in public sector funds? Join us this Saturday where we explore the opportunity in public sector funds and understand if it's the best time to invest in them.
Positioning your portfolio. In every market context, you need to position your portfolio to the emerging scenario. So what is the emerging scenario right now? We are heading into a pre-election phase, and then quickly we will be in election mode, and post-election mode would come before us, and we would be positioning ourselves for a new government. In what way is your portfolio positioned for that? Most people get their portfolio positioning wrong in an election trade. Either they take a very jingoistic one-sided view of the election and get it wrong, or they get the view on the election right. I mean, they call the election right, but their market view of the post-election scenario becomes wrong. Let's see how we can position ourselves right now. Look at the positioning of the domestic institutions versus the FIIs. DIIs have been continuously pumping in money. As of today, in this financial year, about 1.45 lakh crores has come from the DIIs. The FIIs have sold roughly about 15,000 crores net. Within the different asset classes, a lot of money has shifted from equity to debt in the FII portfolio. So FIIs have sold equity and bought debt. So that is not captured anywhere. Effectively, into this election trade, DIIs are traveling with higher equity allocation, and FIIs are underinvested in Indian equities. That's the contrast. Within the DII allocation, we are overinvested in the small and mid-cap parts of the market. It's fairly obvious. And Indian investors are underinvested in the large cap part of the market. Now, if the FIIs like the election result and then decide to come in, generally FIIs come in only in the large cap part of the market or the part of the market where they see value, which today relatively is only large cap. So you'll see a sudden rush of money only in the large cap part of the market, which will probably further take the indices up. Now, there are a lot of domestic institutional investors who are chasing momentum, who are chasing returns. There's a huge investment management industry which is doing the same thing. So suddenly they will be forced to shift capital and invest more towards the index than away from it, because the whole rally and the trade of financial year 23-24 has been away from indices. That's how returns have been generated. People are not investing along with the index. Most of the people are investing away from their index, whichever is their benchmark, and getting the returns. Now this trade will reverse, and it will be done because the FIIs do what they do, which is buy large liquid businesses. Now, are Indian investors positioning themselves for this trade? Should they actually do it? What is the best positioning for a domestic investor? Should he position himself for an equity trade or do an asset allocation positioning where he moves away from equity and waits? These are the questions before us. What are the answers? Put them in the comment section. Let's start a healthy debate right there and see what each of us thinks. Thank you for watching this video.